Good morning, people. Today my lecture is on budgetary control and analysis of variance. So let's start with this. What is a budget? A budget is a financial document used to project future income and expenses. A budget therefore plans future saving and spending as well as planned income and expenses. Budgeting may be carried out by individuals or by companies to estimate whether or not they can continue to operate with its projected income and expenses. So, what exactly is a budget? We all make budgets. I make budget every month, but it really goes berserk because we make so much of expenditure. Every organization makes budget. Even the country, the government makes budget for every financial year. What are they planning to what are they planning to what is their expenses for this year? Every government do that. Around the end of the financial year, we see the budget section, we hear the budget being prepared and being told to the country. So it's a financial document and it projects any future income and expenses. We all make budget every month, every year. So it's a projection of any income or expenditure in an year for the organization. Budgetary control is a system of management control in which actual income and spending are compared with planned income and spending, so that you can see if plans are being followed and if those plans need to be changed in order to make a profit. So you may make budget, the organization makes budget, but it is not that they have made the budget and their income and their expenses would actually match the budget. As I said, that every month I make a budget, but I spend more than I earn. So this may happen with an organization as well. They may either stick to a budget, they may have a very strict budget, they may stick to it. Otherwise, the actual income and spending also can be different from what a budget has been prepared for what the budget plans for them. So how does the budgetary control system works? Firstly, they have to establish a budget. So that's establishment of budget. First you have to prepare a budget. Then continuous comparison of actual with budget for achievement of budgeted figures. You have to compare it. If you don't, as what actually happens, these things are so dynamic today, so if you don't compare, you may be very far behind in income, or you may be far ahead in cost or expenses from your budgeted figures. So if you really want the organization to maintain that budget that has been prepared, you have to compare, so that if you are far ahead in expenses, you can cut down on your expenses, and if you're ahead in income, that's certainly good. Revision of budgets in the light of changed circumstances. You may also have to sometimes revise your budget. You may have to make changes to it. For example, an organization makes a budget with anything, the cost of the raw materials being 10,000 rupees for them for 1 year. However, there is a natural calamity and the raw materials or anything, the raw material have been destroyed, or it did not reach on time to the organization, or it has been destroyed, and whatever is left is being sold to them on a very high price. So what happens now? The actual budget that they had prepared now has to be revised in terms of changed circumstances. So there may be natural calamities, there may be a government change. If a government changes, or any thing happening in the country may also have effect on the budget. So they should be ready to revise the budget. Okay, so what exactly a good budgetary control system may have? Firstly, its objectives should be known. Why are you preparing a budget? Are you looking to only control expenses? Honestly speaking, my budget only wants to control expenses, and it never happens. So you have to be realistic while preparing a budget. It cannot be like an individual budget that I prepare. It's an organization's budget, it's a government's budget. So it has to be realistic, and you should know exactly why you are preparing that budget. Knowledge of cost behavior. The organization should be aware of what costs they are going to incur, because if they are aware of that, then only can they prepare the budget. You don't know anything, how can the organizations prepare a budget? It's not possible. So you should be aware of the knowledge, or you should be aware of the cost. Accurate forecasting of business activities, it is very important, because that is what budget is all about. You should have an accurate forecasting. You should do research. You should be aware, not actually aware, you cannot be aware because it's dynamic, things are dynamic today, but be accurate as far as forecasting is considered. So we see forecasting of the weather system. So we see, okay, I can see, for example, I saw it today that it would rain, and it did rain. So we can be prepared. This is an example. We can be prepared in advance of this. We can take an umbrella if we're going out. So the businesses also have to be they have to do proper research. What they can do is they can employ market researchers who can do forecasting for them. Coordinating business activities. Any budget that is prepared for the organization as a whole, not for just one particular department. So all the departments, whether it is the sales department, whether it's the purchase department, the production department, all should be aware that there needs to be a coordination between them. There needs to be, it's an integrated budget, it's an integrated plan for all the departments together. So there has to be coordination between them. Education. Employees should understand, or rather the management should understand the importance of budget. My budget, I really do not know its importance. I just try to save my expenses, and it doesn't happen. So I have no real meaning of my budget that I prepare. So the management, the management of an organization should know its importance, how important a budget is. Communicating the budget. Once the budget is prepared, it's important to communicate it to all the departments so that they are aware of the budget has been prepared and how it has to go along. Acceptance and cooperation, it should be accepted and the cooperation of all the departments is needed. Reasonable flexibility, a budget should be flexible, because if it is not, then it can become very rigid, which may be a problem in an organization. So it should be flexible. It should not be highly flexible and highly rigid as well. So it should create a balance. Adequate system support, it should have, while preparing budget, adequate support from the accounting team should be there, so that the preparation of budget, rather they have all the data that they need, the data, the information, the records and procedures should be available to them. So providing a framework for evaluation. Once you have prepared the budget, for every department, they can evaluate, they can see how they are performing in terms of budget, in terms of what their expenses should be and what their income is. So it gives, they can evaluate, they can see what their performance is, they can measure it. We'll see the budget types now. How many types of budgets are there? There is flexible budget, there is zero-based budgets, there is master budget, there is performance budgeting. Flexible budget is something, as the name suggests, it is flexible. A budget that adjusts or flexes for changes in the volume of activity. It is also called as variable budget or sliding scale budget. Flexible budgets are prepared at the end of the period when actual output is known. These kinds of budgets are effective in businesses where frequent changes occur due to market fluctuations. So any budget that can change, that is flexible, is called a flexible budget. These types of budgets are prepared at the end of the period, at the end of the financial year, and they can change as per the fluctuations in market. These are flexible budgets. Zero-based budgets are the budgets that are prepared, rather they do not consider the previous year expenses, the previous year budget into consideration while making this year's budget. They start from the scratch. They do not take any previous budget. Generally what happens, we see, okay, last month, for example, just a very quick example, last month I spent 200 on groceries, so this month probably I can decrease it. This is how normally a budgeting is done, but a zero-based budget doesn't consider that last month 200 spent on grocery. It would start from the scratch. A method of budgeting in which all expenses must be justified for each new period. There is no looking behind. Master budget is the collection of all lower level budgets produced by a company's various functional areas, and also includes budgeted financial statements, a cash forecast, and a financing plan. So this is the master budget. Again, as the name suggests, it's a collection. Every department may make their own budget, income and expenses statement, and then it is collected, it is accumulated as a master budget. Performance budgeting. It aims at evaluation of performance of the enterprise, keeping in view the specific and overall objective of the organization. This is something which is based on the performance, what the employees are performing. It considers the overall goal of the organization, the objective of the organization. So this performance budgeting focuses on the contribution of each employee in an organization, and also can act as a control mechanism for them. Variance analysis. Variance, something that varies. Analysis, studying it. So why is there variance, and what does it the studying of the variance is variance analysis. It is a quantitative investigation of the difference between actual and planned behavior. This is what we had thought, this is what has actually happened. This analysis is used to maintain control over a business. For example, if the budget for sales is rupees 10,000 and the actual sale is 8,000 rupees, then the analysis shows the difference is rupees 2,000. Yes, we had expected the sale to be 10,000, but now it is 8,000. So there is not a loss. This will not be considered a loss. This is a variance of 2,000. The organization may then further analyze the reason for the decrease in sales, and remedial actions are taken. Any organization would do that. Variance can be favorable or unfavorable. Favorable when the actual sale is more than the budgeted, and unfavorable when the actual sale is less than the budgeted. So in the above example, as I said, the budgeted sale was 10,000 while the actual was 8,000. So this is unfavorable variance. When the variance has been identified, remedial measures are taken. However, there are situations which are under control of the organization and controlled. It is then called controllable variance. If it cannot be controlled, then it is uncontrollable. There are factors affecting, for example, the actual sales of 8,000 in the example that I gave you. Once the reason for it is found, if it can be controlled, for example, the organization didn't market their product properly, so it is controllable. They can control it. They can after analyzing, they can come to know, yes, this is where the organization, the marketeers went wrong. They can control it. However, the sales didn't go well because there was a natural calamity in the country. There was a recession. There was anything of the sort which the company, which the organization cannot control, is called uncontrollable variance. So people, this is about budgeting and variance analysis. These are the questions that you need to do. And that's it from me today. Thank you very much for listening.